Northern Trust completely shattered consensus for the second quarter of 2026. Diluted earnings per share came in at $4.23, which is an absolutely massive 98% beat year over year. Total revenue on a fully taxable equivalent basis hit $2.7 billion.
Right, which represents a 35% jump from Q2 2025. It's huge.
Yeah, and the market reaction has been really swift, with shares pricing in not just that top-line beat, but the underlying margin expansion. Guidance looks incredibly robust, fueled by generating over 700 basis points of operating leverage for the second consecutive quarter.
And management's commentary is pointing directly toward a heavily strengthening macroeconomic outlook. Plus, the board just authorized a 10% hike to the quarterly dividend.
It's honestly a stunning print.
It really is. I mean, you're looking at a net income of $792.2 million, up from $421.3 million in the same quarter last year.
But to truly understand how a 135-year-old wealth management institution practically doubled its earnings in a 12-month period, you have to peel back the layers of this Q2 earnings release and their mid-year strategic update. So for this deep dive, that's exactly our mission today.
Exactly, because there is a lot of nuance between what is a structural shift in their earning power and what is, a pure balance sheet windfall.
So let's get right into the mechanics of that windfall, because
You don't generate a 98% EPS jump purely on organic asset gathering.
no, you definitely don't. A huge chunk of this beat comes from what Northern Trust categorizes as notable items. Specifically, there's a $525.4 million pre-tax gain just sitting in their other operating income.
Right.
After taxes, that's a $396.4 million benefit straight to the bottom line. And this stems from their participation in the second Visa Inc. exchange offer.
Yeah, this is a really fascinating mechanical quirk of legacy bank balance sheets. To understand this gain, you actually have to look all the way back to Visa's initial public offering.
Oh, wow, going way back.
Yeah, all the way back, because when Visa went public, the banks that originally owned the Visa network received specific classes of stock, often Class B or Class C shares.
Right, and those were restricted, weren't they?
Exactly. Those shares were largely illiquid. They were essentially trapped on the balance sheets, acting as an escrow against ongoing litigation from merchants over swipe fees.
Because Visa essentially kept the banks on the hook for those liabilities.
Precisely. So what you are seeing now in 2026 are these exchange offers. Visa has been actively working to unlock that trapped value for the banks by allowing them to exchange those legacy restricted shares for liquid tradable shares.
Okay.
When Northern Trust participates in this exchange, they finally get to recognize that massive embedded gain on their income statement.
So it's real cash.
It is real cash.
Yeah.
And it significantly bolsters their capital ratios. But, and this is key for you as an investor to remember, it is fundamentally a one-time event. You cannot extrapolate this quarter's $4.23 EPS and just multiply it by 4 to get a forward run rate.
Right. That would be a huge mistake. And what's interesting is how management used that windfall as cover for some balance sheet repositioning. Because in the exact same quarter they recognize $500 million from Visa, they also take a $73.9 million loss on available-for-sale debt securities.
Yeah, they intentionally sold off portions of their bond portfolio at a loss.
Right. Why would they do that?
It is the oldest, most effective trick in bank asset liability management.
Yeah.
I mean, during the zero interest rate environment, almost every major financial institution loaded up on lower-yielding, long-duration bonds.
Oh.
As rates normalized higher over the past few years, those bonds fell underwater. Selling them means realizing a painful loss. But if you have a $525 million surprise gain from Visa sitting on the books, you take the $74 million hit right now. You clear the low-yielding assets off your balance sheet, you reinvest that capital into higher-yielding securities, and the Visa gain completely absorbs the gap loss, so the market barely bats an eye.
So you essentially use the windfall to permanently upgrade the yield of your portfolio. That's really clever.
It is.
But, setting the accounting chess game aside for a second, the metric that should really catch your attention is what happens when you strip all of that noise away.
The organic numbers.
Exactly. If you remove the Visa gain, the bond losses, and the restructuring charges, the core organic earnings per share growth was still 40%. Organic revenue grew by 13%.
Which is wild.
For a mature legacy custodian bank, producing 40% organic EPS growth is staggering.
It is, and it really comes down to the sheer gravitational pull of their asset base. We aren't talking about a regional bank making local commercial loans here. Northern Trust assets under custody and administration, their AUCA just hit $20 trillion.
Trillion, with a T.
With a T. That is up 11% year over year.
Let's contextualize what a custody bank actually does at that scale for those listening. Because $20 trillion isn't money they're just lending out. They are the underlying infrastructure of the global financial system.
They're the plumbing.
Exactly. When a sovereign wealth fund or a massive state pension or like a massive ETF provider buys assets, they don't hold the physical certificates or the digital ledgers themselves. Northern Trust acts as the vault.
Right.
They settle the trades, they collect the dividends, process the corporate actions, handle the tax withholding across dozens of different global jurisdictions. So they are essentially charging a toll for safeguarding the plumbing of international finance.
And that toll booth is incredibly lucrative when equity markets are rallying. I mean, their fees are generally calculated as a few basis points on the total assets they hold.
So as the market goes up?
Because global equities have seen significant appreciation in the first half of 2026, Northern Trust's fee revenue just compounds effortlessly. They don't have to acquire a single new client or launch a new product to see their revenue jump. The rising market does the heavy lifting.
Which is a great position to be in.
Absolutely. This dynamic drove their 8th consecutive quarter of positive organic fee growth. Total wealth management fees hit $592.1 million, and asset servicing fees reached $757.4 million.
But looking at the strategic update, they aren't just relying on market beta, right? They're capturing alpha in very specific, highly profitable niches. In wealth management, for instance, their ultra-high net worth client revenue is materially outpacing the broader retail wealth segments.
Yeah, they're actively consolidating market share among family offices and clients with over $100 million in assets.
And the stickiness of those UHNW clients cannot be overstated.
Oh, not at all. Once you deeply integrate into a family office's estate planning, their philanthropic trusts, their complex tax structures, the switching costs are practically insurmountable.
Nobody wants to untangle that.
Nobody. And we see a parallel strategy on the institutional side within their asset servicing segment. Their alternative assets under administration just crossed the $1 trillion mark.
Now, that is a really critical distinction. Custodying $1 billion of standard S&P 500 equities is, highly commoditized and low margin.
Right. Everything is electronic and automated.
Exactly. But custodying $1 billion in alternative assets like private equity, distressed credit funds, or commercial real estate portfolios, that is a totally different operational beast, isn't it?
Completely different. With public equities, prices are updated by the millisecond. With alternative investments, you are dealing with highly illiquid assets. There are capital calls, complex distribution waterfalls, intricate tax K-1 preparations, and quarterly manual valuations.
Yes. It's a lot of friction.
Tons of friction. It is very operationally intensive. But because of that friction, Northern Trust can charge a massive premium to administer those assets. Crossing $1 trillion in alt administration really cements them as a dominant player in the highest margin tier of the custody business.
Yeah, that makes sense. And we also saw strong performance in net interest income, which was up 11% year over year. Their net interest margin expanded from 1.69% to 1.81%.
Right.
Management attributed this to lower funding costs and a favorable deposit mix, meaning they're paying out less for client cash while deploying it at better yields.
Standard banking mechanics working in their favor.
Exactly. But all of this top-line success brings up a pretty massive question about their capital allocation, because despite this revenue surge, total non-interest expense was actually up 16% year over year, hitting $1.63 billion.
Yeah, this is where we need to dive into the notable items on the expense side, because they recorded $145.6 million in pre-tax unfavorable notable expenses.
Which sounds bad.
It does. If you break that down, it's a $61.5 million charge for software dispositions, $51 million in severance-related charges, and $33.1 million for a broad-based, one-time equity grant to eligible employees.
Okay, I have to challenge the mechanics of this strategy.
Yeah.
On paper, they are firing operational staff to the tune of $51 million in severance, while simultaneously writing off over $60 million in old software.
Yes.
Yet they are handing out $33 million in equity to retain other staff, and their strategic update explicitly highlights aggressive hiring of revenue-generating talent, specifically wealth producers and sales teams.
Right.
If you are aggressively ripping out the legacy tech plumbing and cutting the back-office headcount, but pouring assets into highly complex alternative vehicles and hiring frontline sales staff, aren't you introducing massive operational risk? Like, who is managing the new flow?
It is a totally valid concern, and it strikes right at the heart of the operational leverage transition they are executing. What management is doing here is essentially fixing the roof while the sun is shining.
Okay, unpack that.
They aren't just blindly cutting headcount. They are substituting legacy manual processes for modern infrastructure. The $61 million software disposition isn't just throwing away tools people were using. It's accelerating the depreciation on legacy databases and on-premise servers because they've migrated to cloud-based automated architectures.
So they take the upfront accounting hit to scrap the old system now because they have the Visa windfall to mask the pain.
Exactly. You get the bad news out of the way when the good news is overwhelming. And the same logic applies to the headcount. If you automate a massive chunk of your middle office trade settlement, you just no longer need the same army of manual reconciliation clerks.
Right.
So you take the $51 million severance hit to trim the operational bloat. Then you take the resulting structural savings and reallocate it toward what actually grows the business, high-end wealth advisors and institutional sales teams. You are shifting your cost base from back office maintenance to front office revenue generation.
And the margin data absolutely validates the strategy. The underlying pre-tax margin, excluding all these notable items, expanded to a staggering 39.6%.
It's incredibly efficient.
Yeah, and return on average common equity came in at 25.9%. So by ripping the Band-Aid off on these expenses now, they've structurally lowered their unit cost of custodying assets. Every new dollar of revenue that these newly hired wealth producers bring in will just drop straight to the bottom line at a much higher margin.
That is the textbook definition of operating leverage. Your revenue is scaling infinitely faster than your fixed costs. But beyond the internal mechanics of Northern Trust, this earnings report is loaded with macroeconomic data that every investor really needs to pay attention to.
Yeah, let's pivot to that.
Because Northern Trust acts as the vault for $20 trillion in global capital, their internal risk models ingest real-time institutional data long before it shows up in government lagging indicators.
Which brings us to the provision for credit losses. Q2 2026 printed a negative $5.3 million provision. Negative. Furthermore, their total ending allowance for credit losses dropped to $190.3 million, representing a 15% decline year over year.
So they're releasing reserves.
Right, and under the CECL framework, current expected credit losses banks have to reserve capital not just for loans that have already gone bad, but for the macroeconomic probability of loans going bad over their entire lifetime.
Right, the CECL model is highly sensitive to forward-looking macro variables like, unemployment projections, GDP growth, and asset valuations. When a bank's provision is negative, it means their forward-looking models are signaling such a reduction in overall systemic risk that the bank is legally justified in releasing capital from its reserves back onto the income statement.
But look at where they are releasing it from. The report specifically attributes this reserve decrease to improved credit quality and a strengthening macroeconomic outlook in their commercial real estate and commercial and institutional portfolios.
Right now, it's wild.
This completely flies in the face of the popular narrative. I mean, for years, the headlines have been screaming about a systemic commercial real estate apocalypse, the urban office doom loop, massive defaults, stranded assets. How is Northern Trust looking at CRE data in mid-2026 and deciding things are actually getting so much better that they can shrink their reserves?
Because you have to separate the generic headlines from institutional reality. The headlines are focused on Class B and Class C office space in hollowed-out urban cores, which are often financed by regional banks with massive concentration risk.
Right.
Northern Trust isn't lending to those projects. Their CRE exposure is deeply institutional. We are talking about Class A premium logistics hubs, high-end multifamily developments, and data centers backed by highly capitalized global sponsors.
So it's the difference between a regional bank holding the bag on an empty strip mall versus Northern Trust financing a billion-dollar data center for a top-tier private equity fund.
Precisely. Their internal data is showing that at the institutional level, credit quality remains pristine. The sponsors have the liquidity to cover their debt service, valuations in premium asset classes have stabilized or grown, and the broader macro environment, inflation, rate trajectories, corporate earnings, is heavily supportive of continued growth.
So it's basically a massive vote of confidence.
It is a profoundly optimistic signal for the global economy. When a $20 trillion custodian tells you the institutional credit markets are healing, you should really update your macro priors.
And that economic confidence is heavily reflected in their capital return policy, too. They returned nearly $500 million to common shareholders this quarter through dividends and stock repurchases.
That brings the total capital return to over $1 billion for just the first half of the year.
Right. When a bank authorizes a 10% dividend hike and buys back $500 million in stock, it means their stress tests are passing with flying colors, and they have more capital than they know how to organically deploy.
It is a fortress balance sheet throwing off massive amounts of free cash flow. They have successfully navigated the interest rate transition. They've optimized their legacy cost structure and are now purely in capital harvest mode.
It is a masterclass in cycle management. But before we wrap up this analysis, there is a singular, easily missed detail buried deep in the asset servicing highlights of this strategic update.
Oh, this is the best part.
It really is. Amidst all the massive numbers regarding the Visa windfall, the CRE reserves, and the $20 trillion in traditional assets, Northern Trust casually notes that they are now, quote, live on the Canton network, advancing tokenized funds and digital custody.
That single bullet point might just be the most consequential forward-looking statement in the entire report.
Let's break down the mechanics of what the Canton Network actually is, because this isn't just a corporate buzzword for you to ignore. The Canton Network is a privacy-enabled, interoperable blockchain network designed specifically for institutional financial markets.
Yeah, and think about why that matters. For decades, the core function of a custody bank like Northern Trust was maintaining massive, centralized proprietary databases that recorded who owned what.
Right, and it took days for trades to settle because multiple different proprietary databases at different banks had to constantly reconcile with each other.
Exactly. And tokenization completely flips that architecture on its head. When you tokenize a fund, whether it's a money market fund, private equity, or real estate, you are representing the ownership rights of that asset as a programmable token on a blockchain.
Right.
Settlement becomes atomic. It happens instantly, without the need for massive back-office reconciliation teams.
Which perfectly explains why they are so willing to take a $60 million hit to scrap their legacy software and fire operational staff. They are preparing for a tokenized future where that legacy architecture is just obsolete.
Exactly.
But here is the critical pivot for you to understand as an investor. In a world where assets live on a decentralized blockchain, the role of the custodian fundamentally changes. You aren't paying Northern Trust to maintain a database anymore. You are paying them to safeguard the cryptographic private keys that control those tokens.
The security paradigm shifts entirely. If an institution loses the private keys to a billion-dollar tokenized private equity fund, that capital is permanently gone. You cannot just call up a central clearinghouse and have them reverse the database entry.
No undo button.
No undo button at all. Institutional capital requires institutional-grade security. Sovereign wealth funds and massive asset managers are not going to custody their private keys with a 5-year-old crypto startup. They're going to custody them with the 135-year-old fortress that already handles their traditional assets and understands global regulatory compliance.
So by quietly going live on the Canton Network and building out digital custody infrastructure, Northern Trust is laying the institutional plumbing for the next generation of finance.
Yeah.
The prevailing narrative has always been that decentralized technology and crypto startups were going to disrupt and destroy the legacy banks. But what this earnings report suggests is something entirely different. The legacy banks are simply absorbing the technology. They are quietly building the secure vaults for the tokenized economy from the inside out.
They are leveraging their massive regulatory moat and pre-existing client relationships to ensure that when institutional capital finally moves on-chain at scale, it doesn't leave Northern Trust's ecosystem. It is an incredibly strategic, long-term defensive move that will likely become a massive revenue driver over the next decade.
It completely redefines the long-term growth thesis for the stock. This wasn't just a quarter defined by a one-off Visa gain. It was a quarter where Northern Trust flexed its $20 trillion scale, aggressively restructured its cost base for higher margins, signaled the all-clear on institutional macro risk, and quietly planted its flag in the future of digital asset custody.
Absolutely.
That wraps up our deep dive into Northern Trust's Q2 2026 results. Be sure to follow the show for our daily earnings coverage, where we cut through the noise, skip the fluff, and break down exactly what the market's most important numbers mean for your portfolio. We'll see you next time.